Hey there, MTG Tribe. Welcome back to another powerful Morpheus Swing Trading video. 2 weeks ago, we said in our video that Celsius, CELH, was setting up for a potential buy entry on a pullback to its 8-day moving average. And the very next day, Celsius triggered our buy entry and has steadily zoomed 17% higher since then. Did you catch that swing trade entry? If you missed it, don't chase. That's typically a bad idea. But in today's video, we alert you to two more hot stocks on the Morpheus radar that could be setting up for a potential buy entry in the coming days. First, we walk you through the chart of AMD, a leading semiconductor stock that may soon break out above its 50-day moving average and daily downtrend line right here. We also bring MNDY into focus as a potential pullback setup with a relatively low risk entry point and a high risk reward ratio. Finally, we take an updated look at the charts of the S&P 500 and the Nasdaq, both of which have pulled back to crucial support of their 50-day moving averages. Now, their pullbacks to the 50-day moving average could be a buying opportunity, but will relative weakness in the Russell 2000 small cap index weigh on the market? Join us as we analyze the charts of these benchmark indexes for further insight. But before we look at the charts, be sure to press that like button and subscribe to avoid missing out on our next big win. As always, this video is not financial advice, but is simply our educational read on what the charts indicate. So let's see what the charts say. If you're new to MTG, the first thing you must understand is that the Morpheus swing trading strategy is a rule-based system. That means that we look for specific entry points for swing trade setups that can be defined based upon either a breakout above resistance or a pullback to support. We also look at various chart patterns as well, but one of the main types of setups that we take, especially in a bullish market, is a breakout. So we're always looking for breakouts above key resistance levels. Now, AMD, Advanced Micro Devices, is a leading semiconductor stock with strong earnings growth. And that's one of the things we look for is stocks with strong earnings growth to back up the technical patterns that we focus on as well. And Advanced Micro Devices caught our attention because of its close proximity to the 50-day moving average, this red line. Notice how earlier in June, the price action was trading above the 50-day moving average. And then we entered into correction mode in mid-July. The price fell below the 50-day moving average. Here it acted as resistance in early August. We couldn't get back above it. And now, after a correction of about a month and a half, AMD is now pressing up against testing resistance of that 50-day moving average. Now, what we always look for is what we call confluence or convergence of different resistance or support levels. For example, with AMD, not only do we have the 50-day moving average, but we've got a trend line that also is converging in the same area. If you check this out here, we can draw a trend line from the highs back in June, connecting with the anchors in early August, and you'll see that trend line comes to converge right at the 50-day moving average. Furthermore, we've got a prior swing high that is also lining up as a resistance level. This candle here, this big red candle from the 24th of August, we can draw a horizontal line here across, and we can see that also converges with the high of the past 2 days. So that means that if the price moves above the high of the past 2 days, it will represent a breakout above 3 different resistance levels. And we'll go ahead and just draw a little circle here so you can see the convergence or the confluence. And a move above the high of the past 2 days will put AMD above its 50-day moving average, the red line, above its downtrend line, and above the high of the prior swing high from August 24th. So when you've got a breakout above not one resistance level, not two, but three, then that's much better than just a breakout above one resistance level. In fact, the more confluence or the more convergence we have, generally the more powerful the breakout will be. So that's why we're always looking for a convergence of multiple resistance levels and then looking for potential buy points above that convergence. So we really like this AMD setup. It needs to get above the high of the past 2 days, which is 111.82. And we want to have a protective stop below the 10 and 20-day moving averages. We wouldn't want to see the price come much below those levels if it breaks out above here. So If you are a member of the Morpheus Wagner Daily Service, we'll send you a trade alert with our exact entry and stop prices if we enter this trade. Next up is Internet Stock Monday.com, MNDY. And unlike AMD, which was a breakout setup, MNDY is actually a potential pullback setup. And we can draw a trend line here from the recent highs. And we see that right now the price is actually pulling back to support of that trend line. Remember, the most basic tenet of technical analysis is that a prior level of resistance becomes the new support after the resistance is broken. So that means that after the price moved above this downtrend line about a week ago, that downtrend line should now act as support on the pullback. So that's what we have here is yesterday's low actually converged with the new support of the prior downtrend line. Now, as we just explained, we always look for convergence of resistance or support. And in this case, it's going to be convergence of support because we're looking at a pullback entry. And that convergence we can see right here. We'll go ahead and draw a circle around there to highlight it. And specifically, that convergence is new support of the prior downtrend line combined with the 50-day moving average, the red line, and the 20-day exponential moving average. So you can see they very neatly converge right at yesterday's low to form a very clearly defined short-term support level. We've got the 8-day exponential moving average just overhead, but a move above yesterday's high would put us back above that level as well. So what we like about these types of setups that are pullback setups is we like the fact that they often give us a very high risk reward ratio because of how neatly we can set our stop price. For example, we wouldn't want to see the price of MNDY go much below yesterday's low. I mean, we often get an undercut, we get a 1 or 2% dip below that level, but we wouldn't want to see it go too much below that level. So we can set a stop very neatly, just a couple percent just below the prior low, and that gives us a positive risk reward ratio because if we're wrong, we're out right away. We're out quickly. But if we're right, we could break out to new highs and continue higher. So we like the high risk reward ratio of MNDY combined with the fact that we can have a very neatly defined stop price right below yesterday's low, as well as the triple convergence of the moving averages with the prior downtrend line. And if we spot a valid ideal entry point, again, we'll send a trade alert to subscribers of the Wagner Daily Pro. Now let's take a look at some benchmark indexes as an overall barometer of the market's health. This is the S&P 500 ETF, SPY. And in our last couple of videos, we've been focused on the 50-day moving average, which is a very crucial and pivotal level of intermediate term trend. And we highlighted when SPY broke below its 50-day moving average back in mid-August, and we said that would act firmly as resistance on a bounce. And that's exactly what happened. As we pointed out in our last video, SPY rallied right into the 50-day moving average, and you can see how perfectly it acted as resistance and triggered a big sell-off. However, a couple of days later, we broke out back above that 50-day moving average, trended higher for a couple of days, and now we're pulling back right to that 50-day moving average again. So SPY is now testing that pivotal support level of the 50-day MA, which just formerly acted as resistance. And notice how the 8 and the 20-day exponential moving averages are also in the same vicinity. Now, what we did notice here is that we did get some higher volume yesterday, and we undercut the 50 and 20-day moving averages. So that undercut run stops, and that can be positive. But what we'd want to see is we'd want to see the price action get back above yesterday's high pretty quickly. We wouldn't want to see a lot of deliberation around this level. And if we break below yesterday's low, let's say below the 444 pivot, then that could mean that we've got a failed breakout above the 50-day moving average, and we could start to see more selling pressure. So this is a very important area to keep an eye on in the coming days. Quite simply, if the price action snaps back above yesterday's high within the next day or two, we could see bullish momentum increase in the near term, whereas a move below yesterday's low could attract the bears and also trap the bulls who bought the breakout above the 50-day MA. So it's really a crucial level here in the short term for the S&P 500. Next, let's take a look at QQQ, which is the NASDAQ 100 ETF. And we'll see it's got a very similar chart pattern to the S&P 500 SPY. Now, the NASDAQ is actually showing a bit of short-term relative strength to the S&P 500 because Notice how it's still holding above its 8-day exponential moving average and has not even touched yet the 50 and 20-day moving averages. So it's actually holding up a little better than the S&P 500, although it did sell off on higher volume yesterday. And we can see that we've got a area of horizontal price support here as well, going back to all the way from June. And then we had basically here near the highs of this gap up day. So we've been talking about this level now for several weeks, and that is right around the 373 level as an area of support. And notice how, again, there is that convergence. We've got convergence of the horizontal price support with the three different moving averages. So again, that makes that NASDAQ a pretty good risk reward here. Much like with MNDY, if we were trading QQQ, we could actually have a tight stop in place just below the low of this convergence here, right around the 370 level, which would be below the 50 and 20-day moving averages plus some wiggle room. So if we were long QQQ and it broke below that level, we wouldn't want to stay in because we could have, again, a failed breakout above the 50-day moving average. However, again, QQQ is looking better than the S&P 500, and we see confirmation of a resumption of this strength on a move above yesterday's high. So although the S&P 500 and NASDAQ have pulled back to support of their 50-day moving averages, the one potential gotcha of this whole situation right now is relative weakness in the small cap arena. This is the Russell 2000 Small Cap ETF, IWM. And as we pointed out actually in our last video, IWM is trading below its 50-day moving average. And notice that it was only able to get above its 50-day moving average for one day. We had a one-day overcut here a couple days ago, popped above it, but right back below it. So IWM is having trouble holding above or getting back above its 50-day moving average. And notice how IWM, unlike the NASDAQ and S&P 500, it's actually firmly below its 50, 20, and 8-day moving averages. So they're all acting as resistance now. In addition to IWM being stuck below its 50-day moving average, we also notice that it's forming a bearish chart pattern that's similar to a head and shoulders pattern. And I'll go ahead and annotate it here so you can see. For a head and shoulders pattern, if you're not familiar with that, you can check on our blog to read all about the head and shoulders. I'll go ahead and put a link in the comments so you can learn about the head and shoulders. But I'll just kind of give you a quick rundown here. This is what they'd call the neckline. And here we've got the left shoulder right here. And then we've got the right shoulder on this side over here. And then we've got the head up here. So it's looks like a head and shoulders. Now, this is not, just to be clear, this is not a precise head and shoulders pattern because we don't have the exact match here on the neckline. And the right shoulder went a bit higher, but it is very similar to a head and shoulder pattern and should be considered bearish. In fact, if we get a breakdown below this neckline, below, let's say, the 181 area, then we could see follow through to the downside in this head and shoulder pattern, which could definitely weigh heavily on the market. So you want to be aware of this head and shoulders type pattern that's developing on IWM. So overall, we've got a mixed bag in the market now with the NASDAQ and S&P 500 pulling back to their 50-day moving averages, but IWM forming a bearish pattern and stuck below its 50-day moving average. So the key here is to focus on individual stocks that have relative strength and are largely ignoring the market, such as, for example, CELH, which is trending steadily high. By the way, in the coming days, we're actually doing a complete educational video on how to trade the breakaway gap setup. And we're going to use CELH as our example. So keep an eye out on our channel here. We're going to soon have a video that really dives into exactly how to trade this type of pattern, which is one of our most profitable patterns. We're going to talk about the 5 different ways that you can enter this pattern and profit. If you're not yet a member of the Wagner Daily Pro, head on over to morpheustrading.com and you can get started today to receive our most explosive stock picks with exact entry and stop prices. You also get exclusive access to the MTG tribe and community in the Swing Trader chat room. So we'd love to see you in the community, and we'll see you in our next video. Remember to trade what you see, not what you think.